everybody. Welcome to TraderMerlin Show. It is your Thursday edition, tail end of the week. Day after Jerome Powell and the Federal Reserve made their comments about raising interest rates. They've been at 500 basis points over the last year. Pretty impressive, to say the least, but of course that's going to have impact on our market. And as we like to do when Jerome Powell and the Federal Reserve make their statement and kind of give us clues as to what they may be thinking about going forward, we like to bring on one of my personal favorite guests in the program, which is Mr. Bill Addiss, who's been a bond trader for over 40 years, and not just talk about, okay, they raised 25 basis points, what does it mean? But there's a lot of little tertiary pieces that get modified in the process that don't generally get brought up on your Wall Street Journal, New York Times, Bloomberg type of marketplaces, which is why I love discussing this, because I learned so much about the inner workings of these rate hikes and what impacts it has for you and me. So that said, joining us today, we've got our FOMC actions. I'm going to make him a crown one day. I think I'll 3D print a crown so we can actually look like the animated picture here I have in front of the Federal Reserve. FOMC actions with Mr. Bill Addiss. Bill, how are you doing today?
Greetings, Merlin. Always a pleasure to talk to you and your audience. Thank you for the opportunity.
And the pleasure is all mine because you fill in so many blanks for me and for the followers out here that watch this program with regularity. What were there any big takeaways from a high level perspective that when Jerome Powell spoke yesterday? Any big takeaways for you with regards to what he said?
Actually, there wasn't. I mean, this was probably one of the most boring that we've seen because, the market had a 93% expectation of a 25 basis point hike. So we got exactly what we were expecting. In terms of the long range, they took some of the terminologies, we microanalyze every adjective of an adverb. And even in the press conference, he reiterated the sentence they took out about, future hikes. So that's obviously leading to discussion that maybe they don't have to rate hike for too much longer, if at all. But in terms of what the Fed did, no, there was no surprises. What I thought, though, might be interesting, for lack of a better word for this audience, is we can finally kind of show you how the actions of the Fed are actually impacting the average consumer, including you and I. We talk about the Fed affecting the economy, and it all sounds this ethereal, and, how does it impact us? But the reality is there's a couple of ways we can show you that what the Fed did yesterday really does impact you and I. So I thought we might take a moment in that. And I am going to get a little bit nerdy if you want to go down that avenue.
Nerd out.
Because we're going to time this. No, all right, I'm going to nerd out on you. A lot of people in your audience probably have floating rate mortgages. And the most common benchmark for floating rate mortgages is an interest rate we've talked about for years called the Libor rate.
Right.
And that's the London interbank rate. And people probably didn't even know what the Libor rate was, but their mortgages were benchmarked to this rate. Well, the Bank of England has done away with the Libor rate because the banks in England were lying to the Bank of England for about 15 years and totally manipulating this rate. So that's one of the reasons the Bank of England said, fine, we're going to do away with it.
Hold on a second, Bill. You're telling me that banks are manipulating and lying to the government? No, that can only happen in England. There's no possible way that would happen in America.
No analogy to be sent here to the U.S. whatsoever. This is singular to the U.K. market.
Of course.
There were 13 banks that report Libor, and all 13 were found to be guilty of manipulating. All 13 were fined. Barclays got a $1.4 billion fine, 1.4 billion euro fine, correct me. And now the Bank of England has decided to do away with Libor. But now we've got $1.7 trillion worth of mortgages here in the U.S. that are Libor-based, and the Bank of England is doing away with Libor. So we're going to replace the Libor rate here in the U.S. with an interest rate called the SOFR rate. And that's actually one of the interest rates that the Fed just raised this week. So if you've got a floating rate mortgage, our Fed, by raising this SOFR rate, just made your mortgage more expensive, having nothing to do with Libor. So I thought it might take a moment to explain what this SOFR rate is, what a repo is. We could go down that road, because repo is something that your clients or your audience here probably has never heard about, but they're invested in the repo market. I'll guarantee you indirectly, and I can show you how.
Yeah, so I've got your slide up here. You have a slide that says why SOFR matters to you, which is the standard overnight funding rate. You've got some bullet points on here. You want to walk us through them?
Yeah, thank you. Let me pull up the same, and we can have the same conversation. Thank you. All right. So again, if you've got this floating rate mortgage, the bank has decided that instead of pegging your mortgage to this Libor rate, we're going to do it to the SOFR rate. So let's talk about what the SOFR rate is. And I've gone to the understanding repo slide, Merlin, if you could just move forward to that one.
Okay.
So let's talk about what the Fed is doing here. Our Fed has decided to go out to the marketplace and say to asset managers, we want to hold your money. All right. The Fed has been desperate to try and pull money out of our economy to curtail inflation. And this is one of the big mechanisms they're using. So the Fed has gone out to large asset managers, and I'll guarantee you, if your clients have a money market fund anywhere, their asset managers are doing this. So let's pick on BlackRock just because they're the largest. All right. Every day, BlackRock is being approached by the Fed saying, you have cash on hand. You've got idle cash. You've got uninvested cash. Let us, the Fed, hold your cash. And in return for that, we, the Fed, will give you collateral to hold. So this transaction called a repo is literally, think of it as a one-day collateralized loan. The asset managers are giving the Fed money, and the Fed is giving the asset managers collateral to hold on to. And this is literally just a one-day transaction. Now, tomorrow, the Fed is going to take back that collateral, the bonds that the manager was holding, and the Fed is going to give the client back the money they had borrowed plus a rate of interest. Now, tomorrow, BlackRock will go right back in the market and do the same transaction again tomorrow. But tomorrow, their cash balances are going to be different from today. See, the asset managers and the banks, their liquidity changes every day. This is just a way for us to sop up that liquidity, if you will. So the Fed right now is paying a very attractive interest rate on these repos, 5.25% to be specific. So that's why your money market fund is invested in this repo. The Fed, this transaction used to earn zero a year ago. Now the Fed has raised this rate up along with the Fed funds rate. When the Fed raised the Fed funds rate yesterday, and this is what the press was talking about, they also raised the SOFR rate. So that basically means your money market fund income is going to go up by a quarter point. You can thank the Fed for that.
Yeah, it's interesting.
Does that make sense?
It does. Big Eb says it doesn't seem like much interest percentage, but on $7 trillion, it adds up really quickly. I guess the part that confuses me is when I look at it, a money manager, and I've got, okay, let's say I'm a money manager and I got, $1 billion sitting there that just, it's the end of the day, it's idle. What interest is there in the Fed to take that just for an overnight and then return it in the morning? I understand that we want to take money out of circulation to obviously help manipulate the dollar, but you're only taking out of circulation for a period of just a couple of hours. So I guess my brain goes, well, what does it even matter? What's the point of the Fed taking that short-term loan and paying a ton of money over time for that tiny little window where they're holding it?
And the answer literally is to, and as the economists like to say, sop up liquidity. We're literally looking to do everything and anything that we can to pull cash out of the banking system. And that is effectively what this does. I mean, since the Fed started offering this to money managers, see, let me back up. This opportunity has always been offered to the banks, right? The Fed has always said to the banks, you got excess capital, we'll hold it. And that was been done for decades. It's only recently that the Fed is now offering this opportunity to large asset managers as well. And again, the motivation behind this is the Fed. You and I have looked at the M1 and M2 charts, right?
Yep.
Seen how cash has just exploded. Well, this literally is being done to pull cash out of the economy. Now, you're right. You could say, yeah, but it's only for 24 hours. But if I do this 365 days in a row, as we've been doing, and I do an average of $2 trillion a night, that's not cumulative, obviously, but I have effectively sucked another $2 trillion of cash out of our economy.
Yeah, it's a strange one to me. In my the way my brain works, I always come up with horrible analogies. And let's just say I'm a drug dealer, and I've got some black tar heroin sitting over here in my garage. And I'm like, okay. And a buddy goes, hey, I will hold that for you. It's 9 p.m. So I'll hold that for you until 6 a.m. Like, okay, well, no, it's safer with me. When you go, oh, that guy's going to pay me some interest on it. Okay, fine. I give that to the person. I get it back at 9 in the morning. You haven't taken the black tar heroin off the streets. You've just taken it off the streets for a couple of hours. So I guess what I'm asking is it really that important for the Fed to look at these money managers and say, that little window of time, we kind of want to just prevent you from utilizing that money?
Well, because we don't have, as you know, distributed ledger technology in the government, we have to operate on a 24-hour time cycle. So
Mm-hmm.
you're saying it's just a couple of hours, but it is a 24-hour settlement cycle. So, it is not just a couple hours. But let me look at it. Let me offer another vantage point for the same transaction. Let's say you're a large asset manager, you're BlackRock. You're sitting on $200 million of uninvested customer cash, right? No fund is fully ever 100% invested. They've gotten money from clients they haven't yet put on the market. So let's take an arbitrary figure of $100 million tonight. You're BlackRock, you're sitting on $100 million tonight. What are you going to do with that money?
Right.
Literally. What are you going to do with that money? You can't keep it at the banks, right? This week they showed
We've
the
learned
banks.
that.
Exactly. Yet, you can't. So what are you going to do? You're going to do this transaction.
Yeah.
You're literally going to say to the Fed, here, you hold on to my money. Because remember, this is collateralized. The Fed is actually sending the money managers an equivalent amount of bonds. So from the point of view of the asset manager, this is the safest trade in the world. You're not going to buy commercial paper. Remember what happened to that market back in 2008 with the money market funds?
Right.
So, in times of even uncertainty, this transaction becomes even more valuable to the asset managers. Now we add on top of it an inverted yield curve, and one day is giving you the highest yield in the market and the safest transaction. The asset managers are lining up to do this trade.
Yeah. I guess I would be too. I've got money sitting in a bank. I'd love to just loan it out and get a nice rate of return just for an overnight rate. Why not? You mentioned the yield curve. I brought that one up here, and it's more like a yield cup at this point, given how much of a divot we have. For those that may not be able to see this, let me make it a little bit larger for you. I know, Bill, you can't see this one, but
Sorry, yeah.
if you look at the chart on the left-hand side of the screen here, the one on the left is the yield curve. The one on the right is the actual performance of the S&P 500. So the yield curve on the left-hand side, you can see that the short term has just been jacked up substantially. And of course, that is the current trend. That happened even more so today with 25 basis points for the short side. But the long end of this one is kind of starting to flatline. What are your takes on the yield curve here? Of course, we've got a pretty big inversion. I will show you the rate of inversion right now between the 10 and the 2. You're looking at about 0.4%, so almost 0.5% difference to hold the 10-year versus the 2 years. There you go.
Yeah. No, I continue to have the same vantage point. I'm a bond guy. So when the yield curve went inverted, I have no recourse to say we've got a recession coming.
Mm-hmm.
I've been 40 years of being indoctrinated as a bond guy. So my unfortunate pessimism is I don't think we're done with inflation yet. There's a stickiness to inflation. So I don't believe in soft landings because we've never had one. The press loves talking about it. The talking heads love talking about it. I keep equating it to a unicorn. It's a great idea. I'd love to see one someday.
I
So
believe in Michigan. I think it's Michigan. It's legal. Legal being the key word here, to hunt unicorns. Just so in case anybody might want to go do that, it is legal to hunt unicorns in Michigan. Such a strange thing.
So the arms industry has come out with the unicorn-specific guns, I'm sure, just to address it.
All right. Let me real quickly read one.
Back to the
things. So let me read one thing real quick. So Bill earlier was talking about Jerome Powell and the piece that was omitted from the statement today. And he actually made a pretty big point of it. So let me read to you what was taken out. In the previous documentation said, the committee anticipates that some additional policy firming may be appropriate. So that really right there told the world, if they leave maybe in there, they're probably going to raise 25 basis points, which is why I was hanging my hat on the 25 basis point increase. The change has been, that statement has been removed, and it says, in determining the extent to which additional policy firming may be appropriate to return inflation to 2% over time, the committee will take into account certain factors. Thank you for not specifying what those certain factors are, but I'm pretty sure we know it's going to be employment, it's going to be growth, and it's going to be inflation will be the main three drivers there. So I just wanted to read those ones out to you because it is important to see the syntax changes. And for those who might want to see what the Fed's fund futures looks like right now, everyone is expecting a 99.9% probability as of today that at that June 14th meeting, we're going to get a no change in rates, meaning a pause. And I think that is probably the appropriate thing to do for the Fed because as they continue to jack up this Fed funds rate, banks that have a huge exposure to long-dated bonds, this could make even more of a problem for them. So more manipulation, more problems.
So you're saying that monetary policy has to be altered because of bad banking practices. I mean, the reason we have a banking crisis is we have stupid bankers who didn't realize interest rates could go higher. So we should, and I'm not disagreeing with you. I'm just kind of throwing it out there.
Yeah.
So we're saying we need to adjust monetary policy because of stupid bankers.
And that actually came up in the press conference. It did come up, and asking about is he catering to the banks, and he said repeatedly no. Obviously, what was interesting is he started his statement not by going through the economic data, not talking about the rate announcement. He said, "Let me start by talking about the banking sector. We're safe, we're stable, it's financially secure." I actually there was one reporter, I think from Politico, who said, do you have any concerns that the biggest bank in the world, JP Morgan, is now gobbling up some of these other, regional banks, and you're just pushing consolidation into the bigger banks? Does it create an issue for you of systemic risk? Because now JP Morgan is a major problem. If there's issues at JP Morgan, our whole economy could go down.
Huge systemic risk here.
Yeah.
Huge. I mean, this is my soapbox for just a moment, if you would indulge me. Since 2008, we have had the most accommodative central bank in the world, right? They basically brought rates for the banking industry down to zero all the way back to 2008. There was a little blip up before the pandemic, but basically for most of the last 15 years, banks have had zero cost of borrowing money,
right.
Literally. If you can't make money borrowing money at zero, you shouldn't be in the banking industry. So now this year, rates have gone up substantially for the first time in 15 years. Does that really come as a surprise to bankers? Weren't you and I talking about this for the last year? Is the banking industry really that stupid that they got caught by surprise that interest rates went up and the value of their portfolio went down? This is criminal. I literally think this should be criminal, this level of stupidity and lack of governance by the Fed. Where was the Fed supervising this? Sorry.
No, it's good. It's it's about being aware of what's going on around you. Bill Addiss, or I say your last name. I need to say you're here. I don't need to say your last name. Bill and I recorded some videos for Online Trading Academy. I think it might have been 4 years ago, and we were making the comment saying, look, realistically, if you're in an adjustable rate mortgage right now, you got to be really careful, because how much lower are rates going to go? The probability is higher that they're going to start to move up. And of course, over the next year or so, we started to see those rates move up, and now all of a sudden surging. You were talking about I-bonds and floating rate on bond product, interest rate products back then as well. And it's really just about understanding the ebb and flow of markets, where we're headed. The higher we go with regard to that Fed funds rate, the more it's going to constrict economic growth. So I had a conversation with a friend last night about this, and my argument is there is a lag time between when he does these 25 basis points or 50 or 75 basis point increases, between when that happens and when it actually impacts the bottom line of companies. And I actually am in the camp of thinking this is not going to be a soft landing. It's going to be a fairly ugly one, because again, 500 basis points in a year, we're just starting to see the impacts of the first rate hike that happened a year ago. So I think we're kind of in a dangerous situation here, and it would be in the Fed's best interest to pause at the next meeting and just wait for a few months to see how dramatic those rate increases hit the bottom line of companies, which I think will be a negative third and fourth quarter.
I absolutely concur, because if you think about it, the analogy you often hear is, trying to work the U.S. economy and using the overnight rate of interest, the Fed funds rate, as your primary monetary tool, is literally like trying to wash an elephant with a toothbrush. It's going to take a long time to have in. And that is exactly the case that you're talking about. I do agree. We're doing the impacts we're just now starting to feel are from the beginning of the rate hikes. Yep. Absolutely, including on consumer spending.
Couple good comments here. Tom says, is it stupid bankers or the Fed holding interest rates too low for too long and printing like a drunken day trader? That's
absolutely great. Whoever that was, Tom, excellent observation. Someday somebody's going to have to explain why the Fed, when we came out of the Great Recession in 2013, why did the Fed continue to keep interest rates at 0% for the next 6 years? It was basically just a bailout of the banks. Also, during that entire period, why was the Fed continuing to buy mortgage-backed bonds?
I was just gonna.
Mortgage market has been good for the last couple of years.
You stole that one right from me because I was like, okay, I kind of
Sorry.
get the rates. The rate's fine, it's good for everybody. Let's stimulate the economy, but to keep buying mortgage-backed securities, just like that made zero sense, especially when the appreciation of home prices was like a 45-degree slope straight up. It's like, okay, come on, you can stop backing the housing market. Ultimately, that will come back to haunt them. Big Eb says regional banks we're making a lot of the small business loans. Isn't that a concern that the credit crunch is in the making for those businesses? And I would argue, yeah.
Yes, absolutely. I mean, I've been driven crazy this week by the talking heads on the TV who are spending most of the time now that 25 basis points is out of the way, talking about whether the banking crisis is idiosyncratic or systemic. And I'm getting real tired of those words because if we've had three of the largest banks go under, and by the way, a report just came out tonight. If you saw it, I only saw a headline identifying 1,500 other banks that have this type of mismarketing of their long-term liabilities. What else do you need to define the word systemic? I don't get it why we're now not acknowledging this for the problem. I'm not saying it has to be a crisis, but let's acknowledge the issue we've got, and that's not being acknowledged.
No, not at all. It's somewhat scary. I think we will start to see more of a credit crunch coming down the line. Of course, that'll take a little bit of time to finally get there, but that's that. Yeah, we'll wait and see. I'm expecting there to be more pain on that front, and for businesses that are looking to get loans because of this issue, any regional bank, unless you're J.P. Morgan and you've got infinite backing. If you're a regional bank, you have to be more cautious about your loans that you're giving out. So that's going to impact economic growth. That's going to hurt businesses. So, that I think would further bolster my argument for a rough third and fourth quarter of this year. But, I don't want to freak anybody out or be the doom and gloom person. It's just about positioning yourself with your portfolio to capitalize on the market when it starts to do that. So hopefully we will be doing that. Let's talk about I-bonds. Go ahead.
Yeah, sure. Yeah. Yeah, I thought we'd just spend a moment because there's been a lot of news on the I-bond front. As you know, we've been hawking or promoting I-bonds because I really had a bone of contention that the asset management industry did a horrible job of educating because they had no vested interest in this product. So you did a great job, 3 years ago now, probably, starting to promote I-bonds and these inflation-linked bonds. And during the pandemic, post-pandemic period, when inflation skyrocketed, these bonds offered a heck of an opportunity. And I'm sure most of your audience knows the I-bonds are tied to the inflation rate, the CPI rate, and the coupon resets every 6 months. So in a rising inflationary period like we had, the return on these bonds has been outstanding. Inflation has not been so strong as of late. So we had a recent last weekend, we had a repricing on the I-bonds. Now, the way these bonds actually work is, just to get a little in the details, the minimum coupon for the bond is whatever the inflation changes were over the last 6 months. And that's the floating rate component. And that's the minimum yield that these bonds will offer. But the Treasury Secretary, at his or her discretion, actually can juice the yield up on these bonds, a decision he or she can make every 6 months. And that's what she decided to do this month, this semi-annual reset. So if you just look at the inflation rates, we were looking at a rate that was going to be 3.66 just based on the coupon, based on the inflation. In fact, the yield was set at 4.3, which means Janet Yellen gave us a surprise of an extra 64 basis points that she didn't have to. So thank you, Janet. You're spending the government's money that they don't have, but our I-bond investors are going to get a little bit more yield.
You have it written there, this last sentence on this slide. It says, thank you, but why? Why would there be that incentive from Janet Yellen to do so? You're right. I mean, it's basically pushing out a little bit of extra money that doesn't need to be there. I mean, we as consumers buying these I-bonds, we know, okay, it's tied to CPI. Great. I in full disclosure, I do own some I-bonds just because. Why not capitalize on that nice floating rate? But, even 3.66, you're like, fine, that's good. But, I'm over here going, thanks, Janet. Thank you for the extra 0.64. But why? Why did she need to do that?
And honestly, there's no answer to that. Because last quarter, or last semi-annual, the coupon was up at 6%. And she juiced it up by another 40 basis points. The yield we got last period was even more aberration because she did exactly the same thing last quarter, last semi-annual, sorry. But they never addressed why. Literally, it is a question that is unanswered. So I have no idea why she has chosen to juice up. I mean, let's face it, this is not a great rate any longer. I also want to take a
Right.
moment to put this into perspective right now. I mean, 3 or even the 4.3 in today's market is not the yield opportunity that these bonds have offered over the last 3 or 4 years. So I don't want to be a real promoter of these. In fact, I think there's better opportunities out there personally. But why she did it, I defer. Everybody defers. She hasn't answered it.
So
And I'm going to sound political. Oh, go ahead, please.
I have a hypothesis on why she did it.
Go ahead.
So the Treasury could issue
You
a
know-
10-year. The Treasury could issue a 10-year bond right now for 3.37% today, right? And they lock you up for 10 years at 3.37%. So the cost of capital for the government is now fixed and locked in for a while. It's abundantly clear that the Fed is going to do everything they can to get that rate down to 2%. So if you can entice the population into buying I bonds because, ooh, you're going to get 4.3%. Yeah, that's going to beat the market. Great, you're going to get that for the next 6 months. But if all of a sudden, if we get down to 2%, then all of a sudden that I bond's going to be at 2%. And if you bought that 10-year bond, you'd be getting 3.37 still for the next 10 years. So it's almost like they're trying to get you into that floating rate right now because they're sure that it's going to drop much lower, and therefore it's better for people to buy the I bonds from the government's perspective than buy an outright 10-year. That's my weird conspiracy theory out there, that they're doing this on purpose because they know rates are going to be going down and they'll save themselves a lot more money down the road.
I'm cynical, but you beat me. I'll be honest with you. I'm cynical, but I'm not seeing. You're seeing this as the come on rate to sucker people in the door, huh?
Yep.
Again, I don't know why, but it's kind of been interesting though, watching it from the Treasury point of view. So here at the time when Janet Yellen is doing extraordinary measures to pay the bills, right? I mean, the government's broke. You had a session on it yesterday, I know. The government's broke, and here's Janet Yellen giving us more income on these bonds. Thank you very much. Means they have to borrow more. But I also want to highlight to the audience: there's something happened this week that got very little press, and that's that the Treasury Department on Tuesday actually announced that they're going to start buying low coupon bonds.
Yeah, right.
Locally, the bonds that cost the government the least to finance our debt, the Treasury Department is going to start buying them. Now, that raises question number one is they got to borrow the money to buy the bonds. But the other reason they're doing this is they're worried about market liquidity. See, we're experiencing some liquidity problems in treasuries, and we never used to worry about that. But in today's world, investors are avoiding low coupon bonds because of the low income obviously associated with it. In other words, most like insurance companies, pension funds, mutual funds, they want current income. They want high coupon bonds. So these low coupon bonds are actually becoming kind of museum pieces and rather illiquid. So the Treasury Department, because of the integrity of the market, if you will, have decided they're going to come in and try and sweep up and clean up a lot of these low coupon bonds, but that means they're going to have to replace it with high coupon bonds. So Janet again has made a decision that's going to wind up costing the government some good money here. And we have no specifics on that program yet, other than on Tuesday they announced their intention to do it.
Strange stuff. It's
times we live in.
It's like I always mention how the markets, not just trading, but just the markets overall, is like this four-dimensional chessboard, and Jenny Yellen's actions, like he can sit there for hours and just break down, why are you doing this? What's the action going to be? What's the impact going to be? But then all of a sudden, somebody else will do it. It's just fascinating. It's why we love this stuff. A couple questions came through here. Let's see. Ganesh says, will this create a monopoly of companies like the stock market lately is fueled by big companies without any breadth as medium and smaller companies are failing? So I think what he's asking is, the entire banking sector, I think Jerome Powell even mentioned it during his press conference. There was something like 1,400 banks, and now there's 400 or 600, major banks in the U.S. Does that push to consolidate the banking system create more of a systemic risk than leaving it wide open with a lot of these smaller banks? What do you think?
Absolutely. And I have to put in a plug in a commercial. There's a woman who's the credit markets writer for Forbes magazine, Myra Rodriguez. great analyst, and she just did it. Her latest talks about just this item, that the amount of systemic risk that is brought in as a result of the consolidation. I mean, I know Jamie, I like Jamie, but he's one man, and they're covering 10% of our deposit base here. There is a systemic risk here. Let's acknowledge it. And I also have to continue to stress the regulatory oversight is very questionable at this point. So no, I think you have to worry about antitrust issues basically to the banking industry, like you look at others. And we've learned from Lehman, the whole argument of too big to fail is garbage, absolute garbage. There's no such thing as too big to fail.
No such thing. One other piece I'll throw in here, and this almost sounds like conspiracy theory day. The writing is on the wall for a central banked digital currency, a CBDC. And part of me feels that Jamie Dimon is a puppet master for the FOMC and for the Federal Reserve. I mean, when this initial thing happened with Silicon Valley Bank, Jamie Dimon was meeting with Jerome Powell, was meeting with Janet Yellen. I have to assume there's some collusion there and saying, hey, you know what? If this happens, we'll hook you up and just stay there and do this and bail us out if we... Gotcha, I'll take care of it. Part of me feels like this push to consolidate and get rid of smaller and regional banks is so that you have a few giant behemoths which control most of the action of the United States, and therefore the implementation of a CBDC will be a much smoother transition if you've got a couple juggernauts like JP Morgan and you say, hey, listen, we're going CBDC. Jamie, do you remember what we did for you? Do you remember that gift we gave you with First Republic where you made $50 billion worth of money for pretty much nothing? You now need to really implement the CBDC for us. And he's going to go, okay, sure. Part of me feels like that's the ultimate goal here is to consolidate it down so you have a more compliant banking system to implement a CBDC.
I find that an interesting perspective. I hadn't heard that, but in the way you presented it, it makes it sound like Jamie would be against a central bank digital currency unless he were somehow bribed to support it. I see the banking industry as willing to embrace CBDC for a whole bunch of reasons. So do you see them as actually being obstacles to implementation of central?
No. I don't think that he'd necessarily be against. I think some of the smaller, more regional banks may have a challenge with the implementation and saying that they're losing a little bit of their control. And if you have, it's kind of like trying to convince the masses. If you're trying to convince 300 million people of something, well, that's kind of challenging to do because you have so many different viewpoints. But if all of a sudden we have 10 representatives that make it much easier to disperse this CBDC or this statement or whatever, it just makes implementation easier. Because it almost feels like they're just pushing out competition. They're forcing the small banks out of business. They could have let some of these banks go, right? Some of them did. Silvergate was not in a perilous financial situation, but they shut it down because of crypto related products, right? They made sure all the on-ramps and off-ramps to crypto were destroyed. They've gone after pretty much all the banks now that did that for crypto. So there's multiple motives here for this all to happen. But I think that ultimately we're all going to look at a CBDC in a few years as just being the normal thing. And this will be some of the key steps to initiate it.
I wholeheartedly agree. But I also feel like the old man in the room. I mean, I have to remind people of the type of banking disruptions we've gone through in the past and survived. You out in California, remember we used to have a savings and loan industry before 1980, right? Cal Fed and Columbia Fed and all of that got wiped out. And what happened? We created the Resolution Trust Company, a government agency, just to merge together bankrupt savings and loans. I mean, this was a huge phenomenon in banking history. So we've had banking disruptions before. So when we say there's systemic risk, I'm not calling for breadlines necessarily, but we are certainly having a disruption on the banking side. That's for sure.
Yeah. Let's see. What else do I have here? Are overnight loans guaranteed by the U.S. government? How safe are they?
Well, I'm not going to going back to the repo transaction. I think this question is. When I said that, so for example, the asset manager is giving the Fed $1 million in cash, the Fed is giving them $1 million in collateral, which is U.S. government treasuries. So it is literally a collateralized transaction. So to the extent that U.S. government treasuries are AA rated, we haven't gone into default yet. This is considered to be a pretty safe transaction. It's for every dollar that the asset manager is giving the Fed's giving them an equal amount of treasuries. So it's a very safe transaction.
Yeah, I would imagine there's pretty much no risk to those money managers.
Exactly. And I do point out, and it's probably not relevant to this group, but this repo market is actually the largest market in the world. I mean, every day here in the US alone, there's over $7 trillion trading in this repo market. And by the way, you'll be happy to know, all of these trades are done on distributed ledger technology. This entire market has moved on to that. So $7 trillion a day. This market's bigger than the US equity and FX markets.
Crazy stuff. This is one that I haven't dug into too much, but there was a question that came through here from Margaret. I think it was from Margaret. It's from Lisa. Sorry. Talking about this good credit penalization. Have you heard about this?
Elaborate as you're using it.
So they're basically looking for, Fannie Mae and Freddie Mac mortgages, their upfront fees. If you have a good credit score, they're actually raising the fees. And if you have a bad credit score, they're lowering the fees in an attempt to incentivize those who may not be able to buy a home to buy a home. And I'm just like scratching my head. I don't know all the details of it because I have not dug into it, but it just seems so bizarre that they would do something like that. I thought you might have heard about it.
No, I'm sorry. It sounds counterintuitive to me. I mean, I go back to 2008 and the fundamental premise. If you can't afford to put down 10 or 15%, maybe you can't afford a home.
Yeah.
But I'm old school.
Yeah, if you have a credit score of 600, you're not credit worthy. I'm sorry. 600 is really bad. And I apologize to anybody in the room that may have a 600 credit score. It's easy to fix that. I actually have a whole bunch of videos that I did for Online Trading Academy on how to get your credit score up. You could probably go from 600 to, call it 720, probably in 6 months if you just followed a plan and did good work, and make sure you pay your bills. So I'll dig into that, Lisa.
No, and I would point out, this is proven. One of the reasons we had the financial crisis of 2008 and that whole mortgage crisis is that under Bill Clinton's administration, they dropped the requirements to lend money that you could borrow from Fannie and Freddie.
Right.
And, at one point, you could have a 570 credit score. I don't mean to be cruel and crass, but just because you want a home doesn't mean you can afford a home. But, they literally lessen the credit standards so low. The unintended consequence of that and trying to make homes more available to people, I mean, that was the motivation, was you just put so much more credit risk into the marketplace.
Yeah.
Bankers are good about finding ways around that.
Bankers are good at finding rules around everything. Tell me a little bit about your, I have a focus course that's at Online Trading Academy on cryptocurrency and digital assets. You have is it finally rolled out? Are you officially teaching, or you're almost there?
Finally. Long awaited. No, the good news is we do have a one-day focus. I met with Larry. We talked again today. The final outline is being reviewed, and we're looking to put a one-day bond focus class on the calendar for June. And that's the achievable goal everyone acknowledges. So I'm not trying to tease you, but I'll have an outline together we can show once it's approved. But yeah, we're going to handle bonds from the point of view of the traditional bond buyer, buy and hold, understand bonds 101. But also talk about bonds as a trading vehicle. And for that, we're going to focus on ETFs. So it'll be a full day.
Nice.
There's a lot to talk about because we've got to talk about the Fed and the yield curve and all that, as well as how to invest in the different types of bonds. So I'm looking forward to it. It'll be a fun class.
I am too. It's since the entire time I've known you, there hasn't actually been an official bond class. You got some XLT pieces you were doing, some mastermind pieces, but it's nice to see a nice structured program there. I might be a fly on the wall for your sessions.
Welcome it, anytime. And I'm going to sit on your crypto class soon, I promise you.
The next one is May 17th, so you got a couple weeks here for that one. It's a lengthy one. It's a 6.5 hour session, and I do 4 application sessions. I do once a week, Tuesdays from 10 to 11.
Yeah, the application roster we don't have yet, but we'll be doing the same for this focus class as well. Wonderful. Nice. May 17th. Thank you. I put it in my book.
You got it. All right, Bill. Well, hey, thank you very much. I appreciate you coming on as always and give us some insights into what on earth is going on behind the scenes from the Federal Reserve and the FOMC. Hopefully, we'll have you on before the June 14th, right? I think that's the June 14th. Yeah, June 14th meeting. At the latest, we'll have you on June 14th, maybe before then.
Good. Let's do it. I look forward to it. As always, Merlin. Thank you. Always a pleasure talking with you and your crowd.
All right, take care, Bill. Thank you so much.
You're welcome. Thank you.
Guys, that was Bill Addiss. I didn't plug his website here, but let me bring you out to his website. He has his own website. Where was it? Oh, I had it as a link, but it's AF. Let me bring it up here. AMHERST. AF training. There you go. So here is his webpage. There's also some videos there These got on YouTube as well. But if you go to Amherst Financial Training, which is aftraining.co, that's Bill Addiss's website there, and you can click on subscribe, contact. He's got newsletters and all kinds of cool little stuff that he does. So check that one out. All right, I got to go into Big Ev's comment here. He says, it makes perfect sense if you're looking for new voters. Absolutely. I hate politics. I hate politics because it makes friends and it can make enemies in the snap of the fingers. There's two things they say you're never supposed to discuss. That's religion and politics. And unfortunately, I was dreading making that comment I made yesterday about the church being a business. And I know that some people are like looking at me now going, oh, well, you hate the church. I do not. It's a business. If you look at politics, the goal of that benefit to lenders, right? If you have a bad credit score, oh, now we're going to give you incentives, which flies against the entire reason that you have a credit score, right? A credit score should be, hey, if you're 800, we know that you're credit worthy. No concern for me as a lender loaning you money that you may not pay me back, right? I feel safe. But if you get a 500, 600, it's, I don't trust you. You can't pay your credit cards on time. You're not trustworthy essentially if you have a very low credit score. So Big Eb is right. The reason that this is being done is to attract new voters. It's inclusion. And that's this big ESG social governance issue we have right now, is everything now needs to be all inclusive and for everybody, right? So if you've got a group of 12-year-old girls that are doing a basketball class, then you know what? You should be able to let in 35-year-old men who are 7 foot tall and play against those 12-year-old girls. Why? Inclusion. Make it okay for everybody to compete. I call bullshit on that one. It's 12-year-old girls, and 12-year-old girls only should be playing that game. If you look at what this lending thing is designed to do, Big Eb is right. It's designed to get votes. It's designed to help people who are in a bad financial position get access and maybe become first-time home buyers, which in theory would be good for our markets. However, there should be a qualification in order to buy a home, and it has to do with financial responsibility. Low credit scores generally don't have good credit responsibility. So what's going to happen is ultimately that family may be all excited because, hey, we got a home, we had no money down, but we qualified for this thing because some government policy, and I'm getting preferential treatment because I have a 600 credit score. Most likely what will happen is that individual will end up losing their home again, right? They'll end up losing that home, and you and I as taxpayers will probably have to bail them out because they shouldn't have been in that home in the first place. I really just shake my head at the idiocracy for that. If anything, you incentivize people to get better credit scores. So you say, hey, if you got an 850 or 800 credit score, you're going to get a 10% discount on your mortgage. Now you have all these people who have bad credit saying, let me work towards that. Or better yet, instead of doing that, why doesn't the government set up a program that says for anybody who has a credit score under 720, here's a set of free classes designed by the government to help you understand personal spending, personal income, expenses, liabilities, simple steps you can do to get yourself up to that 720 so now you can really afford a house. Anyway, I'm going off. It's bizarro world in my mind, what's going on with that tax treatment. I'm over 800. I worked my butt off to get over an 800 credit score. To think that I would be penalized because I worked that hard for it is just asinine to me. Anyway, sorry, I'm on a vent. My bad. Jill says, where can we learn more about CBDCs? Well, there's a lot of information out there online about them. I can certainly do a show on CBDCs if that's something that you guys would be interested in. There's actually variations. You have CBDCs. You also have synthetic CBDCs, which there's a lot of chatter about as well, which are, a potential. So I could do a show on central bank digital currencies. Give me a couple weeks, though. I have a couple friends who are kind of big in that space, and maybe I'll try to bring them on. Thompson, by the way, I asked ChatGPT to produce Jerome Powell's speech yesterday. Yeah, pretty amazing, huh? Do you think it will cause a housing bubble, Vernon? I think it could certainly do that. Again, you're going to bring in a whole group of people who shouldn't be buying homes because they can't afford it, right? And maybe it's not that they can't afford it, but they have bad financial management. So maybe they do have some money sitting around, but ultimately they're going to miss their payments, they'll go into default, and they'll lose their home. So I don't think it'll be as widespread as what we saw in 2007, but could it add to the problem? Sure. And I do think that this is a reach to get voters and make everybody inclusive. Have you filed for bankruptcy in the last, just imagine the TV commercials now. Have you filed for bankruptcy in the last 6 months? Do you have no credit whatsoever? Call right now and we'll get you a $400,000 loan. Doesn't matter what your credit score is, we'll get you a loan. That is irresponsible. 2008 all over again. I hope not, but you never know. It could obviously happen. End of thread. And while they're introducing these classes, they should introduce mandatory classes before anyone is allowed to become a parent. Oh, God. Yes, absolutely. Wow. Anyway, we could go on and on. Now I'm getting all worked up. You get me all fired up over here. So we didn't talk about an elephant today. Let me bring up Apple here real quick. So here is your Apple chart of the day. I'll bring this up to the 5-minute. Ooh, nope, I don't want that one. Free trial. I'm not paying for any of this stuff. Let's go to 5-minute time frame here. So, man, not a huge pop out there on their earnings announcement. It looks like it popped up about 1.7%. So not quite the popcorn trade of the day that I would be looking for somebody like Apple. Of course, a little move up for Apple usually means that you're going to see that NASDAQ moving up a little bit from its lows. And we're really, we're not really having that much of an impact on it. We're looking pretty weak out there. So that was the major announcement for today from the after-hours session. With you look at the economic calendar this week, we can go forward and zoom down here to what's happening for tomorrow. The European Central Bank, they raised by 25 basis points. That was normal and expected. For us, unemployment claims were slightly higher but that's really not that big of a deal. If you listen to the speech by Jerome Powell at the press conference, he repeated over and over and over again that unemployment numbers are a key for them at this point. So here's what's happening for tomorrow. We do have more unemployment data. You have the unemployment rate coming out at 5:30 Pacific time. You have non-farm employment change, average hourly earnings, and Canada also has their unemployment rate as well as employment change. So some good stuff there if you're looking for volatility. But again, that's all going to be before the market opens. You do have FOMC members speaking tomorrow. That's going to be Member Cook, and also the financial stability report is tentative for tomorrow, and good luck on financial stability. Let's go quickly look at earnings for Friday. Generally, it's a very quiet day. There's your Apple. So slight beat, Square beat as well. So a lot of good beats on earnings today. Shopify really rocking it, up 23% on their earnings beat. But for tomorrow, what do we have? You got Berkshire Hathaway. That's pretty much it. A couple of energy companies like Dominion reporting earnings as well. And I'll call that a day for your market for tomorrow. All right, so that's it for me. Let me real quickly see if I missed some questions here. Tom is becoming addicted to ChatGPT. It's good stuff. Good stuff. Let's go in here. Will it be as bad as a car loan? Who knows? We may be getting preferential treatment for car loans as well, just to show spending. And again, it's this inclusion thing. Look at the backlash from Bud Light, although I did not check out what happened with Budweiser. Let's look at that one. I was on a rant yesterday about Bud and their recent move, which cost them a lot. Looks like they did pretty darn well. Their earnings was today. No, not their earnings was today, but I guess I stand corrected here. There's usually an E at the bottom of the screen when they come out with their earnings. I could have sworn Anheuser-Busch and InBev was today, but it looks like it's actually going to be on June 23rd? August? No, that can't be. So I guess I missed their earnings. Anyway, I'm going to move on. We'll scrap this one. So that was Bill Addiss for today. Again, you can find out more information by going to Online Trading Academy and checking out his upcoming Focus series, which has been long overdue. You can check out his website at aftraining.co. Tomorrow, it's Friday. God, it's hard to believe that it's Friday. Should be an exciting one. I think a lot of the dust that will be settling from Jerome Powell's comments going into the weekend and which new bank will be going under will be the topics du jour. So we'll talk about that. Of course, if you guys have any comments, questions, feedback, send it in at TraderMerlin@gmail.com. I'm happy to discuss pretty much anything that you guys want to go into. So let me know what it is or put your comments down below any of the YouTube videos. That said, hope you guys have a fantastic remainder of your day. I will see you tomorrow. Take care.